It is January 30th, 2026. If you've been blinking, you need to stop.
Yeah.
You are missing these massive tectonic plates shifting under the global economy.
True.
I mean, we are not looking at small updates anymore.
No.
This feels like a fundamental restructuring of everything. Capital, tech, power. The signal-to-noise ratio is just off the charts.
It's deafening. I mean, the acceleration just this month, just in January, it makes the old quarterly business cycle look, what, archaic?
Completely.
Yeah.
Major players are moving. Like, the window to own the next decade is closing now.
Not in a year. Right now.
Okay, let's just dive straight into the epicenter of this thing.
Yeah.
Artificial intelligence. We've been tracking this space for years, but the sheer scale of the capital being deployed this month, it's unprecedented.
It is.
OpenAI isn't just making business moves anymore. They're basically declaring war.
They're trying to corner the market. The huge news, of course, is the IPO acceleration. OpenAI is gunning for a public listing Q4 of this year, 2026.
And the why here is everything.
Exactly. It's more important than the when. This is explicitly designed to beat Anthropic to the public markets.
It's a race for liquidity then.
It's a race for narrative dominance and for capital absorption. I mean, if OpenAI lists first, they just suck all the oxygen out of the room.
They set the valuation benchmark.
They become the standard, the go-to investment for any big fund that wants AI exposure. If Anthropic gets there first, the story splits. OpenAI cannot let that happen.
And to make sure they win, they're bringing in firepower that, honestly, it sounds like fiction. Amazon.
Yeah.
No, Microsoft. Amazon is in talks to invest up to $50 billion.
Let's just sit with that number, 50 billion.
It's the GDP of a small country.
It's a staggering sum.
Yeah.
And it signals a huge pivot for Amazon. For years, they tried to build everything in-house. This $50 billion check is basically an admission that they can't.
They can't build a frontier model fast enough to compete.
So they're buying their way to the front of the line. It's a massive hedge against their own internal R&D.
But this creates a really strange love triangle, doesn't it?
Right.
Microsoft owns a huge piece of OpenAI. Now Amazon is buying in.
Right.
And at the same time, Microsoft's stock is getting hammered. We're seeing the biggest Microsoft sell-off since, the pandemic crash in March 2020.
Yeah.
So why is the market punishing the early leader here?
Because the market has stopped trading on promises. It's trading on infrastructure realities now. The whole sell-off is driven by Azure.
The cloud growth numbers.
They're underwhelming. The market expected this AI boom to mean instant exponential Azure revenue. And the slope of that line just isn't steep enough. The hype got way ahead of the hardware.
So Microsoft's bleeding, but they're not bleeding out. They made a fascinating counter move this week, a deal with Perplexity AI for $750 million.
This is the hedge. If OpenAI is getting cozy with Amazon, Microsoft needs another horse in the race.
Right.
So they lock Perplexity into the Azure cloud for $750 million. They're securing the infrastructure for what might be the next generation of search.
It's like a game of musical chairs, but the chairs are made of billion-dollar server farms. And while they all fight, Elon Musk is just consolidating power. We're seeing reports of a merger between SpaceX and xAI.
This was always going to happen. It was inevitable. Think about the synergy there. xAI needs just a massive amount of compute and energy. SpaceX has Starlink for global data distribution and, well, arguably the most advanced manufacturing on the planet.
So by merging them ahead of an IPO later this year,
Musk is bundling his hardware advantage, the rockets, the satellites, with his software play. It's a terrifying proposition if you're a competitor.
because if you're a standalone AI company, you're renting servers from someone else.
Exactly. Musk is building the energy, the transport, and the network. It's a vertical integration that is incredibly hard to compete with on cost. It's Apple's closed-loop strategy, but for general intelligence.
Speaking of Apple and closed loops, let's talk about the physical reality check here. The supply chain is just screaming. Apple just beat revenue expectations. Huge iPhone demand. But they're waving a giant red flag. They can't make enough of them.
The cupboard is bare. This is the hardware bottleneck finally hitting the consumer. Apple is explicitly flagging supply constraints on advanced chips.
And their response is ruthless.
Completely ruthless. For 2026, the strategy is clear. They are putting those scarce chips almost exclusively into their 3 premium iPhone models.
So if you're looking for that entry-level iPhone,
You're probably out of luck, or you're waiting a very long time. Apple is protecting its margins. If they only have enough chips for 10 million phones, they're going to build the 10 million most expensive phones.
and this ties directly into what SanDisk is seeing. They're forecasting explosive growth, and they're just saying it out loud. It's all AI memory demand.
It's a classic crowding out effect. AI models need high bandwidth memory, HBM.
Right.
Manufacturing that takes up the same factory capacity as the memory in your phone or your laptop. And since OpenAI and Amazon will pay anything for that AI memory,
The manufacturers pivot their factories.
and consumer electronics are left fighting for scraps.
A classic supply shock. Okay, I want to pivot from digital mines to the actual vault.
Okay.
Because while tech fights over silicon, the financial markets are fighting over the value of the dollar. We have a massive shakeup at the Federal Reserve.
This is the other huge pillar of the 2026 narrative. Trump is getting ready to nominate Kevin Warsh as the next Fed chair.
And Warsh is a known quantity, a former governor, but the market reaction, it wasn't just noted, it was violent.
Violent is the only word. The second the Warsh nomination looked real, the dollar ripped higher and U.S. yields spiked.
The market sees Warsh as a hawk.
A major hawk, someone who will run a tighter ship, keep rates higher to defend the currency, maybe.
And the casualty of that strong dollar was gold.
It fell off a cliff, down 7%, crashed right below the $5,000 mark. For an asset that's supposed to be stable, that is a catastrophic week.
It is, but it exposes this really interesting tension in the market, doesn't it?
A huge one. The divergence between so-called smart money and retail money. Hedge funds have been skeptical of gold for months. They've been short or neutral.
But retail investors have been piling in.
Retail investors, and specifically Asian investors, have been buying hand over fist.
So the regular folks were riding that wave up to 5,000.
Absolutely. Asian investors flooded into gold ETFs as a hedge against their own local currencies. Retail held on, thinking the dollar would weaken.
And then Warsh happens.
Then Warsh, the dollar spikes, gold crashes, and the hedge funds are sitting there thinking, we told you so, while retail is left holding the bag.
It just feels like everyone is on edge.
Yeah.
I was looking at the Bank of America bull and bear indicator. It just hit 9.4.
Which is incredibly high.
For listeners who don't follow this, explain how high that is.
Well, the scale usually tops out at 10. A 9.4 signals extreme optimism. And in contrarian trading,
When everyone is optimistic, it's time to sell.
it means all the money is already in the pool. There's no one left to buy. So technically, yes, it's a sell signal.
And the hedge funds see this. They're shadowing the equity markets, but not to buy more.
No, they're trying to figure out how to hedge against a drop. They're dancing very close to the exit door, just waiting for the alarm to go off.
And they're not getting any comfort from Europe.
Yeah.
The ECB is signaling they're holding rates steady through 2025.
Yeah. Any hope for a 2026 rate hike in Europe is basically fading.
Which just reinforces the strong dollar trade.
It's a feedback loop. Europe is stagnant. The U.S. has higher rates. So capital flows to the U.S. Dollar goes up, gold goes down. It's very hard to break.
So we have a high-stakes tech war, a hardware shortage, a currency shock. In all this chaos, how are actual companies behaving? I saw a headline about GameStop that maybe check the date to make sure it wasn't 2021.
Hey, GameStop is a fascinating case study in a corporate identity crisis.
The CEO's pivoting the whole company.
The whole thing. They want to go from being a dying video game retailer to a conglomerate. He is targeting a $100 billion valuation.
$100 billion you don't get there selling used video games.
No, you don't. The strategy is pure M&A, mergers and acquisitions. They want to use their cash pile to just buy other companies.
Like a meme stock version of Berkshire Hathaway.
That's a perfect way to put it. It's an incredibly aggressive, incredibly risky target in a very expensive market.
And it contrasts so sharply with the rest of retail, which seems surprisingly resilient.
Resilient is the word on Wall Street. Despite everything, the consumer is still showing up. Visa just beat earnings because holiday spending was strong.